So a lot of people trying to figure out what to do with this market. Your philosophy is to buy the market and not individual equities, but this market's been kind of funky. I wonder, does big tech's increasing weighting, say, in the S&P 500 concern you? How do you get as diversified as you want to be?
No, as I said, mentioned before, we don't look at sector by sector. We've been long-term investors, and for the most part, we buy the market. We domestically we own the Russell 3000. We do have active managers, but the vast majority of our portfolio is passively managed. Our equity portfolio is passively managed. Same on the international side. So we probably have most stocks that are available to us.
And that's done pretty well for you. I wonder, with this disconnect between the economy and the market that we're seeing, does that cause you to shift at all your portfolio allocation? Do you have more than usual in cash? Does fixed income mean the same thing that it traditionally did?
Well, that's something that we've been talking about for quite some time. As I said, we won't shift the portfolio very much, but most people look at us and believe that our business is to make the most money as possible. But I try to point out that our primary goal is to satisfy our pension obligations, and that requires that we have the necessary liquidity every month to ensure that we can meet pension benefit payments. We have been restructuring our fixed income portfolio the last couple of years. It's now comprised of half the portfolio is treasuries, which has paid us off very well the last couple of years. It's been surprisingly the last year our best performing asset class. But we've been focusing more to ensure that we've got the adequate liquidity while we're able to continue to maintain the growth bias that we've had for so many years. That's paid us off extremely well. We're proud to say that in the realm of large public pension plans in the U.S., that we've been a top quartile performer for 30 plus years.
Yeah. I'm back, I have to say. This is the joys of working from home. Sometimes your internet signal drops out. But Mansco, it's great to speak with you today. I'm curious about the private markets portion of your portfolio. I think it comprises, about 16% of the overall portfolio. It's been a source of strength for you in recent years. How would you assess private markets right now? Where would you be putting money to work? And how would you compare that to some of these public markets that we've been talking about?
Well, we've always liked private equity. We've been private equity investors since 1981, and that's paid off very well. Private markets, which for us is predominantly private equity for quite some time. We're very large energy investors. We're kind of waning off of that now for a variety of reasons. But we've of late also been doing more direct lending to go along with mezzanine investing we've done over the years. And we've not been as much in real estate, something that prior to the pandemic, we've been giving considerable thought to increasing what we do there. We've been predominantly U.S. focused in our private market portfolio. Going forward, we believe that we need to have greater global exposure there. We like private markets. I've really been a fan of private equity more so than public equity. A lot of that has to do with the agency principle I look at when I play in with public markets. People who are selecting stocks are agents, but they're really agents, whereby in private markets, our GPs are principals. They've got better alignment with us, and they have much more control over what happens with companies than public market managers.